Hello and welcome. You're watching Business Today Television. This is Market Today. I'm Sakshi Batra, and on this special edition, our focus is on the Q3 earnings. Engineering Research and Development Services provider Persistent Systems has reported the earnings for the quarter. In fact, it reported a net profit of 286 crores rupees for October to December period, which is a growth of 8.1% compared to the September quarter. Over here, the operational performance has also been strong. EBIT has stood at 363 crores, which is 9% higher from the September quarter. The EBIT margins have also expanded by about 60 basis points to 14.3% from 13.7% earlier. Now, to discuss more details on the earnings front and the outlook, I'm now joined by Mr. Sandeep Kalra, who's the Chief Executive Officer of Persistent Systems. Warm welcome to you, Mr. Kalra, and thank you so much for taking the time out for this discussion. Let me kickstart by asking you, for a quarter that's the industry-wide impacted by seasonality, higher furloughs, how do you see the quarterly earnings that have come about on various parameters, top line, bottom line, the operational performance as well? How do you see the earnings that have panned out for in this quarter for you in terms of the various verticals performance as well?
So first of all, Sakshi, thank you for having me. And you summarized the profitability growth over the quarters. Let me just start by saying the Q3 revenue came in at 300.55 million. That represents a sequential growth of 3% in dollar terms quarter on quarter and 13.7% on yearly basis. In rupee terms, this translates into 3.6% quarter on quarter and 15.2% on year basis. And let me just highlight a couple more things, and then I'll come to the vertical side of it. So for your viewers, this is a quarter where we announce our dividends. So we announced a dividend of 32 rupee per share on the face value of rupees 10. And the board of directors also recommended a stock split, which is an important thing for your viewers to know. The split would be from face value of 10 rupee per share to 5 rupee per share. Now, in terms of operational performance, the best performance came for us in the healthcare life sciences segment, where we had won significant deals over the last few quarters. So the most amount of revenue growth for this quarter for us was in healthcare life sciences, followed by tech companies, followed by a slight weakness in BFSI. Banking financial services, typically this quarter for the full industry sees a number of furloughs. That's where there's a seasonality every year, and we also saw that. Now, from a order book perspective, we declared a very healthy order book of more than $500 million in total contract value, and that should bode well for the future.
Absolutely. So that's what you've summarized very properly for all our viewers to really understand. Let's delve a little deeper into each of these points to understand better as to how the company is planning to move forward from here. Just like how you also pointed out, the seasonality factor was something that the industry-wide impact has been felt. When do you see the impact of seasonality ending? Is it going to be persisting in the Q4 also as well? Would you continue to see higher furloughs in that quarter as well? And in terms of the macro environment, how is the demand environment really looking like for you?
Right. So if we were to start with the furlough side of it, typically the furloughs are the most in quarter 4 of calendar year for the US side, because that's the financial year end. So we see that every year, and we do not expect this to be a bigger play in the next quarter, so which is the current quarter for us. We do see a very small thing, and that's business as usual. So nothing major to be worried about on furloughs front in the current quarter. Now, as far as the macro is concerned, macro continues to be fluid, although it may be slightly improving, but long way to go to come to a normal. And we'll see how the Fed goes about the interest rate decreases and so on over the period of time. But for us, what has stood well for us as a company is when there's a weak macro, you need to work with your customers in a slightly different manner. Whether it is about how they're looking at their cost, looking at their next generation initiatives and so on. And that's panned out very well for us. And even channels like private equity, where they carve out companies from weaker companies and set up newer companies, that has timed up very well for us. So it's company specific in any sector. In a bad macro also, there'll be companies that will outperform competition, and that's what we are focused on.
Okay, do help us really understand when it comes to the demand scenario. You did say that it is going to be continued to be an uncertain environment for some time to come. Especially on the margins, I wanted to now understand. You've reported an improvement in the margins, but this was also a quarter when large part of the industry did dole out a lot of wage hikes, and there was a certain impact. So I wanted to understand from you, what was the impact of that for you as a company going forward? Is this the kind of band that you're looking forward to in terms of margins? Are we going to see an improvement going forward? Could you share with us a guideline on that front?
Sure. So for us, the salary hikes were done in time a quarter before. So we see that every year, and we do not expect this to be a bigger play in the next quarter. So So for us, the salary hikes had kicked in earlier, which meant that our margins for the last quarter had dipped. And now we are working our way up through it. So for us, for Q3, the margin headwinds were more than compensated by the accretion based on our IP revenues, higher utilization, lower travel expenses, rationalization on SG&A, and overall expenses, which is where we are looking at cost optimization for our own sales as we go along to bring the margins back. So that contributed to the margin improvement in the last quarter. Now,
Hmm.
if we look forward, if we look over the next several years, we have said that our aspiration is to improve our margins by 200 to 300 basis points. That will come on behalf of better utilization. So right now, our company utilization for our engineering headcount is at 81.5%. That should see improvement significantly going ahead. SC&A for us, if I compare 9 months gone by this year to the 9 months in the last year, it is 50 basis points above because the market was weak and we needed more pipeline to come in to be able to have the order book that we needed. That should also, as the market stabilize, give us more leverage. That should also basically bring the SG&A spend back. There is investment we have done in facilities, in hiring leadership, capability build. That should also give us margin leverage. So as we scale, we are definitely looking at improving our margins over the next 2 to 3 years. 200 basis.
Okay. You also pointed out that this was also the first ever quarter for the company where you've crossed $500 million in total contract value. The order bookings for the quarter have been strong at $521.4 million as well. What does the deal pipeline really look like from here on? Of course, in the last few quarters, we've been constantly hearing from IT companies talk about, clients cutting down on spends. There is a pricing pressure that you've been feeling, but the kind of deal wins that you have posted gives us a strong hope that perhaps this could continue as well. So what could be the outline over here?
Sure. So please keep in mind, roughly about 79% of our business comes from the US and
Yeah.
North America. For them, the financial year closing is in December. So our Q3, which is Q4 for them, sees a bump up in our bookings, both from a renewal and new order perspective. So that's one thing that does it for us in terms of having a bigger order booking. Overall, if I look at the overall order booking year on a year, it grew by about 18.5%. Now, the pipeline is healthy. We let the quarter pan by. We don't give you forward-looking guidance, so I'll refrain from giving any quantitative numbers on that. But the order book is good, and the fact that not just the last quarter, but for last several quarters, we've been announcing decent order wins, and they're translating into revenue. That is where the order book to revenue growth reflects in our journey ahead.
Okay. I'll also now ask you on the employee hiring plans as well. The total headcount for you for this quarter, what is it at now? And going forward from here, how are you looking at hiring freshers? Is it on track? Because in the last few quarters, again, something that the industry was dealing with is perhaps not honoring the, perhaps all the hiring plans that were first earlier set because of those slowdown pressures. Did you face something like that in the previous quarters? Are things looking up from now onwards? And what are the plans going forward, especially now that we are also talking about Gen AI, which will also come in my next question to you?
Sure. So overall, the company headcount today stands at about 23,336 at the end of last quarter.
Hmm.
Now, we added 494 colleagues in the quarter.
Hmm.
Of this, 75% of the headcount is the lateral hires. We
Yeah.
did bring a certain amount of freshers. In the year so far, we have brought in about 400 freshers, and we have honored every commitment that we have given to any fresher. So there's no offer that has been, taken back or anything like that. So although we have moderated the fresher hiring, 2 years back, we did far more than this, but in line with our requirements, we have a certain strategy of hiring freshers and we are sticking to it. So as far as that is concerned, fresher hiring will be on, lateral hiring will be as we are booking orders. We keep a, plan, which is our annual talent plan, which we refresh on a quarterly basis. So all of that bodes well for us so far. So hopefully that gives you an answer.
Right. So, as far as Gen AI is also concerned, this has now become a word, not just a buzzword, but something that IT companies are on an every quarter basis taking more seriously now. Tell us, what are your own plans when it comes to Gen AI? Will this also augment some external hiring for you going forward from here? Which are the key verticals that Gen AI will be extremely important for you going forward from here? Gen AI as a vertical, as a division, what do you foresee going forward from your meaningful contribution really coming in on the top line from Gen AI? How do we see that trajectory for you?
So there's a bunch of questions there. Let me try
Yeah.
and so from a Gen AI perspective, look, generative AI is another form of AI. It is so AI is not new to any one of the technology companies, and especially people like Persistent, where even the name Persistent comes from persistency of databases. For the last 30 years, we have been working on databases, data, and as AI evolved, we have been doing very significant projects for our customers, including things like in healthcare, for example, tracking renal disease progression, even predicting renal disease progression in newer patients based on the data analysis, machine learning, and so on. Similarly, in financial services, fraud detection is something that we've done for years using machine learning and so on. So now what the generative AI thing does is it's another one where a layman and even the engineering folks can use it much more effectively. What this will drive is, on one side, productivity from an engineering effectiveness perspective. On the other side, it will also open up avenues in different verticals, as you rightly put, whether it is healthcare, life sciences, financial services, any vertical. And there are some horizontal use cases like contact center optimization. So Persistent does not play in BPOs and so on, but we can use the GenAI technology very effectively to disrupt the BPO industry. And we may need much lesser people to do repetitive tasks and make them even more effective. All of this will spawn off newer work. And for anyone to implement Gen AI beyond a proof of concept, you need to do a lot of things in your own enterprise, prepare your data on an ongoing basis, and enhance it on an ongoing basis. So it definitely bodes very well for forward-looking technology companies like ourselves. And you will see us talk more and more about AI being infused in everything. So it's not that a different AI vertical will come in. AI will be infused in everything we do, whether it's a service line or an industry vertical.
Okay. When it comes to even attrition, your attrition levels have also halved, which is like, sharp improvement from earlier. A year ago, it was around 21.6% odd. Right now, it's around 11.9% odd. I wanted to understand, will this be a more comfortable zone that you expect the attrition levels to be here? Are there further levers for you to further bring down the attrition levels from 11.9% odd?
So if you look at the overall industry, so that 11.9% that has happened for us is not just a persistent phenomena. It is
Yeah.
about the industry slowdown in growth. So when the growth slows down, the opportunities for people and the race to hire people at any cost, it kind of mutes down. That's also contributed to our attrition levels coming down. Not to say that our own initiatives have not contributed to it. They have definitely contributed to it in terms of our employee value proposition. But this is an overall industry phenomena as well. We are comfortable where it is. Anything in the band of 10 to 15% is a comfortable range for us, given the fact that we are forward-looking technology players and our talent will always be in demand.
Okay, just last couple of questions for you, Mr. Kalra. One, that you also mentioned that the company is now approved a split of equity shares in the ratio of 1:2. That means one equity share with a face value of 10 will be split into two shares, with a face value of 5 rupees, and the stock split is likely to now happen. Now, could you share with us any deadline and, what are the procedural levels that you will be looking at so that the investors can also be more prepared for this upcoming split?
Sure. So look, we have to get the shareholder approval. So we'll do a postal ballot, which should take a few weeks. In terms of the end to end, it may take between 75 to 80 days for the split to get effective. So there are certain regulatory conditions that we have to fulfill. But from a board perspective, the board has approved. Now it has to go to shareholders, which we are hoping will get approved, and it'll take its own due course. By 75 to 80 days time, it should be fully effective.
Okay, 75 to 80 days is when we are looking at the timeline, most likely. All right. The last question then, coming your way, for the entire new fiscal year, FY25 as well, what is your own sense? You did talk about uncertainty still being there present at large, especially when it comes to your biggest market, the US right now. By when do you see that improvement coming in for FY25? Is there any sort of a revenue band that you're looking at? Earlier, the company was aspiring 3 to 5% growth on a quarterly basis as well. Do you see that happening for the entire new fiscal year?
Sure. So first of all, we don't give forward-looking guidance, so I'll not put a quantitative number to it. All I can say is the markets have been fluid for quite some time. It can only get better from here. And
Hmm.
as it gets better from here, hopefully the opportunities open up even more. And we have had 15 straight quarters of revenue growth and profitability stabilizing and increasing. And if you look at our forward-looking indicators, the order book is a very good forward-looking indicator for things to come. So I would request your viewers and you to look at that, and balance will let the time play.
All right. Well, on that note, thanks a lot, Mr. Kalra. It's been a pleasure speaking to you on Business Today Television and understanding more insights about the quarterly earnings. All the very best to you for the upcoming quarters as well. And here's hoping that we can touch base again to understand more about how the business is really shaping up amidst the macro environment as well. Always a pleasure to host you on Business Today Television, sir.
Thank you, and it was good talking to you.